Okay, the webinar is live.
All right, and so I will call the meeting to order, the Board of Police and Fire Pension Fund Commissioners. Ann, you want to do a roll call?
Sure. Board member Gary is not here, and I'm here. Board member Ford,
Yes.
board member Weitzel,
Here.
and he's here, and Chair Rowden
I'm here.
is here. And we also have a member alternate Bellman here.
Present.
Okay, so moving to the consent calendar, does anyone have anything that they want to pull off of consent? No.
Nothing here.
Does someone want to move consent? Someone want to move consent?
Move that we had adopted. Yes, I move we adopt the consent calendar.
Can I get a second?
I'll second.
Okay.
So board member Ford,
Yes.
board member Weitzel,
Yes.
Chair Rowden,
Yes.
and I vote yes. So it carries.
So now we have public comment, and I don't see any attendees. So we will move on to announcements. Does anyone have any announcements? All right,
Oh,
then we are moving on to reports. So Dewey, if you would like to make a presentation.
Great. Let me share my screen real quick. Can everyone see my screen all right? Okay.
Yep.
So good seeing everyone. So this is a report for the first quarter performance of the pension account. Similar to the previous quarters, we structure it with asset allocation, cash flow analysis, and then performance data, the performance number. As of the end of March, so end of the quarter, this is the current the allocation in the portfolio, roughly about 2% in cash, 43% in fixed income bonds, 51% in stock and equity, and basically the alternative is the equity would focus on higher dividend and interest. So overall, the portfolio, it's roughly 45% cash and bonds and 55% equity, right in line with the low end of the fixed income guidance of the investment policy statement of the pension. Just to comment on this current allocation, this is over the last several years, we have reduced fixed income. Basically, any money that needed to be distributed, we raised from fixed income more than equity. The way we saw the environment has been fixed income has generated very low interest rate. Equity, on the other hand, because of the low interest rate environment, it helps equity return. And so for the last several years, we raised more money from fixed income, and this is where we are. Our view is bond yield interest rate it's not going to change for at least another few years in terms of the short-term interest rate. So we don't see this changing anytime soon, and likely we're going to maintain this allocation. Although the guidance in the investment policy statement put a minimum of about 45% fixed income, right in line where we are fixed income and cash. So if we need to raise cash, and I don't think, we talked about it last time, Heather, I don't think we're going to need to raise more cash for distribution this year. But if we do, we'll evaluate if we need, to come from fixed income or equity. And at the end of the quarter, the balance in the portfolio is $3.3 million. This is the cash flow change for the last quarter. We started the year with 3.4 million. $300,000 was distributed out of the account. The income generated, basically the interest and dividend, 18,500, and the gains from the investment is 179,000. So total return, it's the income and gains, 197,000. Net out to or total to 3.3 million at the end of the quarter. That is for the last quarter. The numbers since inception. So here's the portfolio when we started in September 2009, 10,900,000. The total distribution has been 13,944,000. Income, so interest and dividend, close to 2.2. Capital appreciation is 4.1 million, and the total returns roughly 6.3 millions over the 11-12 years period. This is the performance for the last quarter and last 3 years and since inception. So if you take a look, year to date, basically it's just the last quarter. The market overall is an extraordinary quarter. The portfolio of the pension has done a lot better comparing to previous quarter. And there's a reason for it. Remember, we talked about the previous quarters, the investment in the account or in the strategy of the pension has been on value stock on the equity side. And on the bond side, it's higher duration, longer duration type of bonds. So if you look at the overall last quarter on the fixed income on the bond side, the portfolio went down. The bonds allocation went down about 3.4%. The equity went up 15.8%. Last quarter was a largest quarter in terms of the market we call value rotation. So in the previous quarters, growth company outperformed value. And if you look at the numbers in the previous quarter, the pension account underperformed the broader market because the broader market focused more on growth. Within the last quarter alone, value stock went up significantly and across the board. So if you look at the fund, up 15.8% comparing to the S&P. The S&P is more, the broader market with a little bit tilted toward growth because of the large growth company driving the biggest return in the S&P. So S&P returns 6%, a little over 6%. The equity fund in the pension went up 15.8%. That's the dramatic difference comparing to the previous quarter. The alternatives, this is basically just the equity with the focus on dividend and the alternative fixed income. So for these alternative, historically, we have been targeting 5.5 to 6.5% return. Over the last 8 years, it's right in line on the top end of that, just because equity has historically, on average, is over the last 10 years has been higher than historical average. So it's right in lines. This number, because of the income focus, it has some value tilt. So this last quarter has done very well as well, beating the S&P. Over the last 3 years, the portfolios returned 7.7% and right in line with the number since inception. I think we exchanged email last quarter or a couple quarters ago regarding the expectation going forward for actuary calculation for the pension. If you look at the data historically, for a balanced portfolio, 50% bonds and 50% equity over the previous 80 years, on average, you're looking at around 4.5 to 5.5% return for a balanced portfolio. If you look at the number over the last 12 years, it's 7.7%. So it's much higher than historical average. So if you think that, you know, the market overall, the stock market has a tendency to go back to, to the mean to average, that means that over the next 10 years, you kind of have to expect a lower return in terms of equity. Kind of like, you know, we get a lot of the return up front over the last 10 years. A lot of, you know, the next 10 year would be, you know, payback time. So there might be a period of you know, the market may continue to go up at this pace, but at some point there's some correction. And when you take into the account the correction and you average it out, if you believe that historical average is going to revert, then you know, we should expect for over the next few years the market return for the pension to be a lot less comparing to where it was, you know, over the last 12 years. But if to just look at the equity alone, it's, you know, 12%. And take a look at this. This is more folks has always focused on value stock. If you look at the S&P, you know, growth and value averaged 14.5% over the 12 years period, much higher than historical average. You know, 8%, 9% is the historical average. So just, you know, kind of a note, mindful that over the next few years, things might change and it might go back to you know, lower return. That is the normal course for the market to go. This is the holdings in the portfolio, the detail holdings. So the bond funds are the two Dodge and Cox income funds and the PIMCO investment grade bonds. Now, if you look at the bond funds right now, the current yield is roughly 2% for the Dodge and Cox and 3.3% for the PIMCO fund. The reason for higher yield is it take a longer duration type of investment. So when interest rates start going up, the PIMCO bond funds got, you know, went down more than the Dodge and Cox. On the equity side, it remains the same Dodge and Cox stock funds, and right now the holding is about 1.68 million. Last year, the pension had a little bit of international stock in the account during the sell-off of you know, the COVID sell-off of last year in March, early March. We decided to get rid of international and completely move away from international stock. There was so much risk. We don't plan to move back into international stock just because the pension has enough equity right now, and looking forward over the next few years, you know, in terms of the fundamental, U.S. equity present a stronger case to stay in there. So we're not trying to rebalance the portfolio to add more international into the portfolio. And this is where the balance is $3.3 million. Moving on to our market outlook for the next quarter. This is just this page is just a look back of the last quarter. As I mentioned, last quarter's a tremendous quarter overall. The S&P US stock went up 6.2%, international went up 3.5%, emerging markets up 2.3%. So again, US has outperformed the international market. If you look at the trolling 1 year, the reason for the outperformance in emerging market was just emerging market went down a lot more comparing to US. So this is at the end of March of last year, and most of the sell-off happened and it bottomed right in the middle of March toward the latter end of March. So March 23rd was the bottom in the overall global market. if you take a look at the end of March up until now, emerging market went up more just because it went down a lot more comparing to the US. But if you look at the 3 years average, US continues to outperform 16.8% comparing to 6% of developed international and 6.5% emerging market. In terms of bonds return, on the longer term bonds in US bond treasury, because interest rate went up significantly over the last quarter, long-term treasury went down pretty dramatically, so down 13.5%. In the intermediate, so this is more of a 5 to 7 years bond, down about 2%. And then corporate high yields, basically junk bond, slightly up. And if you look at commodities, almost everything up except for gold. Oil's up, all of the other commodity went up. That was the anticipation of the reopening of the economy, inflation would return, so commodities started going up. Gold, because of the gold, most investors see gold as a hedge on equity. When equity went up, gold went down slightly, or in this case, down 10%. That's the natural course when you see equity stock up pretty dramatically. But over the last 3 years, commodity, basically, that's a gauge of inflation. We did really have inflation, and gold was higher. This is our firm outlook for this next quarter. The way we see is the economy, economic growth is starting to accelerate as at the end of last quarter, going into this quarter. Economic data has shown that the growth can be, it's going to accelerate from now to the end of the year. With the anticipation of economic growth, investor was worried about inflation, and that was the cause of long-term interest rate going up. Despite this, the Fed continued to believe that the inflation number is temporary, so they continue to maintain very accommodative policy, very low short-term interest rate. So this we'll have to monitor and see how it play out. But in terms of short-term interest rate, the Fed has a lot of control over it, so it's likely going to stay low for at least another 2 years if the Fed is doing what they've been saying. In terms of longer-term interest rate, the last quarter, after a significant jump in February and early March, it has leveled off, and that's kind of give the market, the equity market, a little bit of stability. Back in last quarter, back when interest rate moving up dramatically, there was a period of volatility because in the equity market, investors were trying to put a value on stock. If interest rate go up this way over the next 6 months, how would that affect stock prices? And that caused some volatility in the market. As soon as the interest rate level off, the bull market kind of resumed, and the equity market continued to go up. So our view is stock market from now to the end of the year would be continued to be positive, although at this point in time in this quarter, year to date, the S&P has returned over 12%. So if you look at valuation, it's looked a bit more expensive comparing to earlier in the year. So we still believe this is going to be a very positive year, but from now to the end of the year, return on equity might be muted just because where we are in terms of valuation. And then the economic data shows that economy is getting back on track, but the source of volatility for the market over the next quarter or coming quarters would be mostly on bond yield, inflation data, and the discussion on taxes, how to fund the stimulus package that was or the infrastructure plan that being discussed. So any of those things, you know, would put some increase in volatility in the market. Not necessarily the way of you know, last year when we have this huge drop. We don't foresee any kind of big drop, but certainly if there's a significant increase in bond yield, a spike in inflation data, or you know, a tax plan over the next couple years that may negatively affect the market may go down slightly. And right now, for most investors, they're looking for excuse to realize the profit. So if there's right now, the trend is going up, so investors are participating. But if there's any news that could derail, you know, the trend, most investors will try to capture and, you know, take some profit and put money off the table, or take money off the table. In terms of U.S. economy, I talked briefly, but you know, the economic data over the last month and a half or so has shown that economic activity is starting to accelerate. The key thing is you know, the vaccine rollout is, you know, right now over 40%, I think, of the U.S. population has been vaccinated, or at least got the first shot. There were 250 million people receiving the $1,400 stimulus check. So over the last year, you think about it, we had portion of the economy shut down. A lot of, you know, activity, normal activity, were delayed. So there has been a lot of pent-up demand. With household savings went up record high. There is a lot of inclination, and with the stimulus, a lot of you know, expected spending to be had over the next few quarters. That's going to drive a lot of economic spending for this year. Even though, you know, employment number is still below pre-pandemic level, meaning unemployment is still high. For the portion of the economy that has, you know, less affected, or has been less affected by the pandemic, the household savings gone up dramatically. Global economy, it's a different story, but it starts with the management of COVID-19. So for the country with higher vaccination rate, we think that they would have a, you know, much faster chance of returning to normal. Although, you know, if you look for the most part of Asia, they were less affected comparing to Europe and America. But with the US and UK leading the vaccination effort, and part of Western Europe, global economy is slowly getting back on track. But the flashing red points right now are, you know, Brazil, India, and Russia. I'm going to skip the next few pages. In terms of equity valuation, I mentioned earlier, you know, right now, when you look at the return overall, so far this year is up 12% in terms of the S&P. Valuation looks a lot more expensive comparing to where we were just, you know, 4-6 months ago. And I talked about the value rotation from growth to value. When you look at valued stock historically, and the sector that you look at are financials, energy, utilities. When you look at them in terms of valuation, they're not really value company anymore, because they've become a lot more expensive comparing to where they were. So it's to us, it's a flashing yellow sign But because what I talked about, anticipating of economic growth, a lot of fiscal spending, a lot of monetary or a very accommodative monetary policy, likely the market will continue to perform. But it's not going to be the same, 12% for the next quarter, likely a lot less, but it's not going to be a huge drop to reprice the equity market. International, and we talked a little bit about it, but overall in the pension account, we don't own dedicated international investment funds anymore. Certainly the fund that we invest in has some component of international, very small component, but our view is still over the next few years, international or US will continue to outperform the international market just because of how we have dealt with, or not dealt, but how our vaccine rollout has been so far ahead comparing to the rest of the world. And lastly, this is our portfolio view or our asset view for stocks and bonds. It has been the same for the last few quarters, and it's going to remain the same. Our view for global equities is neutral. So we liked being in stock and equity. It just right now, valuations to us seems a little bit high. In terms of fixed income and cash, we have an underweight. So that is the reason why we kept the allocation at 45%. It's because the interest rate environment, short-term interest rate is very low. Long-term interest rate, the trend is interest rates, it's going up. So when interest rate go up, it pushes pressure on long-term bonds. So we want to be underweight bond for in this environment. We have real asset and alternative. We don't have any of that in the portfolio of the pension, but we have a positive view on these investments. And that concludes my presentation. Any questions, concern, change?
Thank you.
All right. I will stop share and thank you very much. I will look to see everyone next quarter.
Thank you very much.
Thank you.
Thank you. Bye.
All right. So now, so moving on to section 6, we have 6.1, which is approval of July 2021 rate changes. I'm actually like ahead of the game this year. It's exciting. So hopefully if we pass this, then everything will be on time for the changes for service retirees in July. Does anyone have any questions on this? No? Can I get a motion to approve?
I'll make the motion, Heather. John Weitzel.
Thank you. And can I get a second? All right. I see a hand from member Ford. All right. So, Ann, you want to do a roll call?
Yes. Board Member Gary? She's here. So we'll come back to her. Board Member Ford? And he votes yes. And Board Member Weitzel?
Yes.
Chair Rowden?
Yes.
And Board Member Gary?
Yes.
Great, thank you.
So I'm ahead of the game for service retirees, for disability retirees. We missed this last one. So I am looking for approval to give retroactive payment for disability retirees We updated their rates effective for March, but they're in the packet for you guys to review. But I'm looking to go back. I think it was November for PD and July for AFFA. So if, are there any questions on the disability retiree calculations? Oh, you're on mute. You're on mute.
Okay.
There we go.
Okay. It keeps muting itself. Is this an annual thing or something that is done, how,
So
or
these
when?
retiree calculations happen every July, and they are a 3-year
Okay.
average. For disability retirees, they are pegged to current MOU changes. So disability retiree changes should happen when active employees get changes to their MOU.
Okay.
So there are at least 3 different calculations depending on who you are.
Okay. Do you want me to make the motion that,
Would love for you to make.
that we go ahead with the calculations for
Retroactive.
retroactive? Thank you. I lost that word for a minute. See, go on to something else that I forget. Retroactive pay calculations.
Alright,
And I'll second that.
thank you.
So Board Member Gary,
Yes.
Board Member Ford,
Yes.
Board Member Whitesell,
Yes.
Chair Rowden,
Yes.
and I vote yes. So the motion carries.
Perfect. All right, and still no attendees. So do we have anyone that wants future agenda items?
Besides the normal stuff,
Yeah. No more retroactive payments, I promise.
Cool.
All
Till
right.
next year.
Hey, no, I'm gonna be on top of it this time. You do it. All
I
right.
hope to be also.
So our next meeting is July 27th at 4:30. And I think at that we are adjourned. Thank you, everyone.
All right. Thank you.
Thank you. Have a good evening.
And Heather, thank you.
Good job.